Hi there. This is going to be a series of many videos that's related to the subject of financial indicators. Financial indicators are very important subject. It's a subject that actually government officials and stockbrokers, investors, project managers, business owners and individual and decision makers pay a great attention to, because those financial indicators, they are the one who determine what's the outcome of the nearby and the faraway future. So therefore then we can base our decision on like making a new project or expansion and so on and so forth. So it's a very important subject, very complex. I tried here to make it as easy as possible for the common man to understand. There will be like many videos series. The first one will start today. It has to do with the personal income tax rate, and then after that many videos will follow. So please pay attention to all this detail as much as possible. So our subject today will start with the personal income tax rate, because this subject is very close to our heart. Okay, so first thing we'll do, we have to understand what is that personal income tax rate. The personal income tax rate, it's a significant financial indicator. Why? Because it directly affects individual disposable income, and that's where the consumer spending comes, and the saving, and the overall economic health. Also, government and decision makers utilize this personal income tax rate to balance economic growth. So if the economy is sluggish, you will see your taxes go a little bit lower to encourage you actually to spend more money, and that will fuel the economy and make the wheel greased up. So to manage inflation also and influence various market conditions. So now we'll see many aspects that this personal income tax rate affects, and from there we're gonna go and see how it affects it. For example, you have to remember the personal income tax rate has two levels: either it's high or it's low. We're going to address both of them and the aspects it affects. We'll start with the low personal income tax rate. First of all, market confidence. Individuals usually have more. If the personal income tax rate is low, the individual will have more disposable income, which of course potentially would do what? Will lead to increased consumer spending, and there will be a higher demand for goods and services, and that will improve the marketplace. So the market confidence will go up. Second one will be government debt. What's going to happen to it when we have a low personal income tax rate? It can result in a reduced tax collection, because your income tax rate is lower, which potentially of course increase government debt. If spending of course of that government, it's out of control. So what's gonna happen? The debt is gonna go higher. Okay, now if the low personal income tax rate, what's gonna happen to the interest rate? A reduction in tax rate can lead to an increased spending. Why? Because now people will have more money, which may cause inflation, and inflation will lead central banks to raise interest rate to control this inflation. So the interest rate will go up. What about the bonds? The bonds, actually lower personal income tax rate might reduce the government need to issue more bonds. Why they issue more bonds? To cover their expenses. But since already the personal income tax rate is low, consumer will spend more money and will buy a lot of stuff, so the increase in the sales tax revenue, will reduce the government reliance on issuing, new bonds and borrowing money from outside investors. So the bond, will go down in the price. How about the corporate earning? What's going to happen to it? When we have a low personal tax rate, it will lead to increased consumer spending. What will happen then? Will prompt company to ramp up production, because the people now has a lot of money. The companies wants to earn that money, will expand operation and invest in the market. So the corporate earning will go up. What about the product pricing? What's going to happen to it? When you have a low personal income tax rate, that will increase disposable income due to lower, of course, tax, which will push demand higher for product and services, and sometimes allowing company to raise product prices, because now the consumer has more money, so the product price will go higher. What about employment? What's going to happen when the income tax rate is low? That will encourage, higher consumer spending, will make the company, and businesses to hire more people and workers to meet those increased demand. So the employment will go high. What about the stock? When we have a low personal income tax rate, that will boost consumer spending, which will mean increase company revenues and profit, and that will positively affect stock prices and corporate earning. Stock price will go up. What about inflation? What's going to happen? When you have a low personal income tax rate, that will increase what? Consumer spending, which can drive up demand for goods and services, will possibly lead to inflation. So the inflation will go up. Now let's look the other phase. When we have a high personal income tax rate, what's going to happen? Let's start first with the market confidence. What's going to happen to it? The market confidence actually, will be reduced due to the reduced disposable income, which will potentially dampen the consumer spending, and that will lower the market confidence. So market confidence will go low. How about the corporate earning? What's going to happen to it when we have a high personal income tax rate? A high income personal tax rate might, result in companies adapting cost-cutting measures, which will reduce investment or delay expansion plan. So the corporate earning will go down. What about then the inflation? What's going to happen to it? Of course, that will lead to reduced disposable income, and that will suppress demand, which may help, of course, to control the inflation, because now people not spending too much, so not pushing the price to go up to cause the price to be inflated. And that's actually, it's a good way to do it. And what about bonds? What's going to happen to the bonds? If a tax rate are high, and consumer spending fall, the government, what they will do, the government might then need to issue more bonds to cover its, debt and its deficit, which will potentially lead what? To change in that bond yield. The new bonds will be issued, will have a higher yield, but the older bond, that has the lower yield will be not attractive. So the bond here will actually work the opposite way. So it will go higher in its yield. What about the interest rate? What's going to happen to it? When you have a high personal income tax rate, the interest rate, when taxes are high, and consumer spending decrease, of course, due to that high because taxes, because now he doesn't have that much money available at his disposal. Central bank then they might lower the interest rate. Why? To stimulate the borrowing and investment of the consumer and businesses. So actually the interest rate will go lower at this point. What about the product pricing? What's going to happen to it? Of course, when taxes are high, demand might decrease, that will force companies to what? To keep prices stable or even lower them, to maintain sale. Otherwise, it's enough already the tax is high. Also, you're gonna have the product prices high, nobody then will buy. Okay, now what about the government debt? Okay, what's gonna happen to it when we have a high personal income tax rate? That can increase, of course, government revenue from these taxes, which will potentially reduce the need for borrowing and will decrease the government debt level. That's for the government. Okay, now how about the stock? What's going to happen to the stocks? Of course, now you have a higher personal income tax rate. People don't spend that much to buy, which can result in reduced consumer spending, which will potentially impact corporate revenue negatively, which will lead to lower stock prices and reduce corporate earning. What about employment? What's going to happen to it when you have a high personal income tax rate? That could reduce, consumer spending, possibly will lead what? To reduce business revenue. And that will have an impact on employment opportunity, where employment will be much lower because company don't need that much employees because the sale, it's really not great. Okay. And this is here, you can see it's an overall picture of how it looks like, both side by side, for your own entertainment. Okay, now let's look at what's gonna happen and the effect, of that personal income tax rate on, disposable income and consumer spending. I have here 3 charts. One, this is here, as you can see, the personal income tax rate, as it goes higher, and then here the value. The first one will be the effect of that personal income tax rate on disposable income and consumer spending. Okay, you can see disposable income, which is this one, is going lower as the tax rate, of course, here it keeps going higher. As the tax rate goes higher, people will have less money to spend. Got it? Now, what about the personal income tax rate impact on stock market and corporate earning? Is very obvious. As you have more higher taxes, people will have less money to spend, so company will gain less money in the market for their product, so therefore their stock will go down and will lose value. Now let's go with the third one, which is the personal income tax rate and government debt level. As you increase personal income tax rate, of course, the government debt will go lower because the government now has much, taxes being collected from the individual. But that also has a bad effect on the consumer itself, because when you take money out of the pocket of the population don't spend money then to buy product, available, and that will affect, the sales will be low, and that will reflect on the companies who produce those products because they're not selling, and that in turns will make those companies really lose money and revenue, and their stock goes down, and a lot of people will be laid off, so there is an effect of, positive and negative. So you have to be creating that balance between those two. Very, very important. So I hope this video was very beneficial for you, and probably I'll see you in the next video. Bye bye.